My name is Joe Kalinowski, and I'm here representing JSK Partners of New York, Disciplined Asset Management, Investing for the Future. Before I begin, I want to thank the Alliance for sponsoring the event, and I also want to thank my friends Reggie Grant and David Grayson in the back there for the invite. I'm honored to be here. I'm going to start with a disclaimer. I got my Chief Compliance Officer in the back saying, yeah, you will. So basically, this is legalese stating that past results do not guarantee future performance, and any investment that is made should be consulted with your tax accountant or attorney. Simple enough. Okay, about JSK Partners. We're a registered investment advisory firm. We were founded in 2005. We formulated our mission statement basically around the need for a disciplined approach in a turbulent market. We had so many investors, think back to 2008, the economic meltdown. You think back, uncertainty regarding monetary policy and fiscal policy in this country, European debt crisis. Given this increased uncertainty in the market, our clients are looking for the tools to navigate through the trying times. And through our proprietary models, this is our mission, this is what we're offering our investors, just some footing when things get rough. We're in essence bringing Wall Street to Main Street. The same models that a typical large hedge fund would be using is what we're using, but we're offering it to the everyday investor so that they have a fighting chance to make some money in the market, right? Expertise at JSK. So my background is, my education is in finance and economics. In the late 90s, I helped formulate models that dictate monetary policy. I worked with the Federal Reserve Board. I worked with Alan Greenspan. In early 2000, I wrote an opinion piece for the Wall Street Journal, basically saying that the dot-com bubble was about to burst, and I advised all of our clients to go into cash probably sometime around the first quarter of 2000. So, we preserved a lot of capital.
You call me?
Not yet, Reg. We will, though, when you invest with us. In 2004, I was written up in Forbes magazine as one of the top 15 high-profile stock pickers on Wall Street. And I did many TV shows, CNBC, Bloomberg, CNN. And with all the appearances, I'm still kind of nervous up here, so just never get used to it. Right? No, I'm okay for now. The stock market. The market is dynamic. It's living, it's breathing, it's the sum of a million motions expressed in one tick. And that's really the core behind our firm. Okay, so as a fundamental analyst, I've always done earnings analysis, cash flow analysis. You can analyze a company every which way but Sunday, but a lot of times that stock price still goes down. So there is a dichotomy between the company and the stock. It is this psychology, this emotion that we set out and we attempt to capture that mathematically. This is the concept of behavioral finance, and really that's the core, or that's the concept that we built the entire firm around. Looking at the way investors and traders tend to react, there's certain flaws that human beings and investors and traders, they tend to exhibit. But the wonderful thing is that they are predictably flawed. So we can come out, and we found 4 basic concepts that each and every trader tends to exhibit through nothing more than just an emotional flare-up, we'll call it. The chart there, it's a basic cycle. So basically, when the market is going up, as we are in our current state, there's a lot of overconfidence. So investors, rule number 1, investors tend to be overconfident in their abilities. Every trader, every portfolio manager is always saying, well, I can beat the S&P 500 every year, I'm that good. Then when things go sour, some kind of crisis happens, some kind of negative event, there is an overreaction. So there's a scramble for the exits, and everybody's ripping their money out, and the market is crashing and coming in for a major correction. That's law number 2, overreaction. Third, when the dust settles, and people realize that the world is not coming to an end, they tend to move back into the market in a herd-like fashion. No one wants to be left behind. So what we're seeing now today, I consider somewhat of a melt up. So everybody who tend to miss this last rally, now they're saying, oh, I'm going to catch the last end of it, and that's the herd mentality. And of course, the fourth law, of course, is what is irrational will soon become rational. So there's a huge mean reversion component to our model. That's our 4 laws that dictate the model that we created. So this is what it looks like. We basically break down the market into 5 distinct cycles, starting from the top, extreme euphoria. Heading down, you got greed. That middle white area we'll call just a rational market, and then below that you have fear and extreme panic. Our model will fluctuate between these 5 cycles at any given point in time, and where we are both tactically and strategically within the model is how we put together our portfolio. Let's take a look at the model. That's what it looks like. There's 2 ways to interpret this model. One is tactical, one is strategic. Okay, very simply put. And by the way, this model, this is an aggregate of several underlying models that we have put together, and we just aggregate into one easy-to-read model. But this is basically the behavioral model. This measures the sentiment and captures the emotion of the market. Tactically, pretty easy. You see an orange line there. We call that the trend line. When that line is sloping positive, you want to be long the market, buy stocks. When that line is sloping negative, you want to be out of the market. You want to be in cash, or if really compelled, you want to be short the market. There's also a strategic interpretation here, and I put a couple of circles on there. Depending on where the turning point is in the model, whether it's in that extreme panic zone, that fear zone, is how aggressive you want to be in your purchase, or if you're selling or going short the market, where you want the green extreme euphoria, it's how aggressive you want to be on the short. So tactically, the model tells you when to buy, when to sell. Strategically, it tells you how much to buy and how much to sell. So in the end, it's not rocket science to interpret it, but ultimately the foundations are pretty solid. All right, this is the interesting stuff right here, the bullish case for our model. What you see there is the S&P 500 going back for 5 years, beginning at somewhere towards the end of 2007. I use this graphic because what you're seeing is a lot of volatility with no return over the past 5 years. The model, and what I did there was I put those green shaded areas. And that's basically when the model told us to be in the market. And that white area, the white areas in between, that's when the model told us to step aside, either go to cash or go short the market. Ultimately, over this time frame, the S&P was somewhat flat, down slightly over the past 5 years. The long-only portion of the model produced a cumulative 5-year return of 58.8%. That's just active management just on the bullish case, using our behavioral model. Here's a bearish case. Same thing, S&P 500, go back 5 years, basically a flat return. The red shaded areas are when we were in cash, or in this case, short the market. And when I say short the market, a lot of folks are going to get spooked and say, oh my God, it's, shorting the market. It's not that hard of a concept. Essentially now, with all the ETFs that are coming out that move inverse the market, it's very easy to take advantage of market declines if you feel compelled to do so. Also of note, which I think is pretty interesting, in all of 2008, the model kept us out of the market for 75% of the year. So we would have been in cash and or short the market. And I guess what I want to stress is returns are important, but equally important is risk management, right? At a time like 2008, I think capital preservation was probably the top concern outside of trying to make as much money as you can in the market. So there's 2 sides of the coin. They're equally important, risk and return. And this is it put together. The red areas when we're short, green areas when we're long. The model produced a cumulative return of 153% over the past 5 years, compared to the S&P 500 that was down 3.8%. Again, using highly liquid exchange traded funds. This is a momentum model. This is a trend model. It's a probability model. So basically, when I get a reading, I say, okay, the market has an X% chance of going higher from here, an X% chance of going lower from here. So what we want to do is we want to capture that trend. If I were to buy a basket of stocks, let's say 40, 50 stocks. And I just wanted to take advantage of that momentum or that trend. By doing it with individual stocks, I'm adding to the portfolio an unwanted increase in systematic risk, meaning that of the 50 stocks that I own during earnings season, I may have something like Apple in there that's just, misses their earnings and the stock is tanking, and it's just increased risk in the portfolio that I don't want to see. So I use ETFs. Basically, I'm going to only buy broad-based market indices, S&P 500, the NASDAQ, the Russell 2000, the Dow Jones Industrial Average, and I use this model along with those ETFs, highly liquid, to produce returns that are probably better than a lot of the stock pickers can produce out there today. So my return per unit of risk is much higher than an average stock picker.